We have about $250 billion of treasuries that are maturing in the next few weeks, just in the next 4 weeks. Then you look at the Treasury general account where it's standing. Well, just a couple of days ago, it was under $50 billion, right? So as the Treasury is now issuing more bonds, it's going to fill that up to a level that they feel comfortable with. You don't keep your checking account at $200 if you have thousands of dollars of expenses every month. You keep enough in there that you feel confident that you're not going to overdraft, right? So they have to have enough in there. And that target is estimated to be about $550 billion by the end of this month.
Despite the debt ceiling debate being temporarily on hold, experts are warning investors about another serious economic challenge that lies ahead for the United States within the next few months. Over the past few months, while House Republicans and the Biden administration were having their back and forths about increasing the debt ceiling, the Treasury Department, in addition to other measures, was rapidly depleting the Treasury General Account, TGA, an account that serves as the government's primary operational account. The TGA functions as the federal government's checking account, facilitating the processing of financial transactions and helping maintain an appropriate cash balance for the government. After the debt ceiling was hit in January, the Treasury helped the country avoid a default by rapidly depleting this checking account. By May 31st, the TGA's opening balance was just about $48 billion, about 94% lower than it was in the same period in 2022. With the debt ceiling debate temporarily suspended, the department will now be tasked with refilling this important checking account to ensure that the nation can continue to finance its obligations. According to Wall Street estimates, the U.S. Treasury will need to unleash its tsunami of new bonds that could suck out about $1.1 trillion from the markets. According to experts, this presents a particularly difficult challenge for the banking sector, which is yet to fully recover from its previous Treasury's bet. It will also be another drain on dwindling liquidity as bank deposits will be continuously rated to pay for the bills. Another issue that has experts quite worried about the Treasury's timing is the Federal Reserve's ongoing quantitative tightening measures to lower inflation. Some experts are predicting that the impact of the double QBT could easily surpass the after effects of previous debt ceiling standoffs. During a recent discussion with Kitco's Michelle McCory, popular Bitcoin advocate and financial analyst James Lavish analyses challenges refilling the TGA presents for the markets and the overall economy. According to the former hedge fund manager, the Treasury and the Federal Reserve is about to create a $1 trillion vacuum that could create a severe liquidity crisis. Lavish begins his analysis by explaining what the TGA is, why it was depleted, and how the Treasury could go about refilling it. Most importantly, he details how the double QT by the Fed and Treasury Department could impact the U.S. economy in the coming weeks. We will now bring you clips from the discussion. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks and enjoy the video.
The Treasury, the U.S. government, operates in a perpetual deficit. Right. So if the Treasury was a company that traded on the New York Stock Exchange, it would be classified as a zombie company. And what I mean by that is the Treasury doesn't generate enough income, right? It doesn't really generate income. It taxes income. It takes taxes away from the productivity of its citizens and its companies, but it doesn't tax enough to cover all of the expenses. And that means that we operate in a deficit. And so every single time that a bond matures, we have to issue another bond in order to pay the principal on that last bond and keep the system going. And that checking account is just where those funds get dumped in once we do float another bond. If you remember, back in January is actually when we tripped the limit, right? So the debt ceiling has been raised. It's been raised 19 times since 1997 and now 20 times, right? This is kind of a raise. They just pushed it off and said, we won't raise it. We won't, we'll allow the Treasury to operate on the current status. But so the problem is that back in January, you remember that Janet Yellen, the Treasury Secretary, had announced that they were running out of money. We actually had already tripped the debt ceiling. And so she's using extraordinary measures, in her words, in order to keep the government operating. How does she do that? She was borrowing from certain programs, that the retirement programs of like the postal office and other programs internally, that military programs that they weren't paying. So there are internal debit and credits that were happening in the Treasury. So that's one thing. We don't know exactly how much they swapped back and forth internally on their balance sheet. However, we know that it was significant. That's number one. Number two, we have about $250 billion of treasuries that are maturing in the next few weeks, just in the next 4 weeks. Then you look at the Treasury general account where it's standing. Well, just a couple of days ago, it was under $50 billion. They have to have enough in there. And that target is estimated to be about $550 billion by the end of this month. So if you add all that up, it gets to be about $1 trillion, according to Goldman Sachs and JP Morgan. They're estimating about $1.1 trillion that they have to fill up in the next 6 to 8 weeks. There's another problem, right? So we've been talking about, you and I talked about this a number of weeks ago, about how the foreign countries are just not buying our debt like they were before. Japan, China, large buyers in Europe, they're not buying it. Well, the issue is, we have issued so much debt in the United States, and every country is issuing debt. Everybody's operating, not everybody, but most countries now, developed countries, are operating in deficits. So the problem is that we're crowding out balance sheets, right? So where is that money going to come from? Well, if you look internally in the United States, there are a few places that they could tap, right? So the Treasury could issue long-term bonds as normal, and 10-year treasuries. They could issue 20, 30-year treasuries, and the banks could use their reserves to buy them. There's about $3.3 trillion of reserves right now that are sitting at the Fed, that are on the bank's books, right? That they could use that. However, there are liquidity limits that keep them from buying too many treasuries. So there's only so much that they can do there.
According to Lavish, the Treasury Department has about $550 billion worth of treasuries to issue before the end of the month, and about $1.1 trillion worth in about 8 weeks. And this is all coming at a time when other central banks are trying to get as far away from the US dollar as possible. The next likely candidates would be U.S. banks, which understandably have limited appetite for Treasury bills at the moment. But even if banks avoid the Treasury auctions, clients withdrawing their deposits en masse to buy Treasuries could wreak serious havoc in the banking sector. Citigroup estimate that bank reserves could fall by $500 billion in 12 weeks, which would undoubtedly send ripples through the entire banking sector. Let's get back to the interview as Lavish further discusses his assessment of the situation.
Number two, we've seen how banks and their reserves, they have to be really careful about what they own right now. And if they're expecting that treasuries the Fed is going to keep raising rates into this quarter, then they have to be careful they don't buy treasuries that will go down in price after they buy them. So that's another thing.
Right.
Then they can look at the reverse repo. We've been talking about this for a while too, is that there's over $2 trillion in the reverse repo. What is that? Well, that's where banks are parking cash that they can't use to buy treasuries because of those liquidity limits, right? So they're using that money in the money markets and trying to avoid those liquidity issues. However, because of this, there's something called the supplemental leverage ratio, and it limits how many treasuries that these banks can own. So unless that supplemental leverage ratio is changed, they really can't unlock those treasuries, unless the Treasury issues shorter paper, which is something that they may do. They may end up issuing like T-bills, really short paper, in order to get around that and tap those markets. So your question was, you're getting to, is this tightening or is it not? Is it going to tighten liquidity in the markets or is it not? Well, if they use instruments that will draw from the reserves, then yes, it is tightening, absolutely. But if they draw from the repo market, it's not really tightening, because that money is just sitting idle on the Fed's books anyway. So Yellen would have to deliberately go after the repo market by issuing shorter paper. You've got $1 trillion that the Treasury has to issue in bonds over the next 6, 8, 10 weeks. Yeah. And you're talking about either a third of the reserves, assuming that we don't have huge buyers elsewhere. There will be buyers elsewhere, but this is a massive amount of treasuries that they have to issue here. And don't forget, we talked about just a few minutes ago, the United States operates in a perpetual deficit, right? So if you look back at the Congressional Budget Office does these studies, and they show what the budget is and what they expect and how they expect liquidity to be. And right now, they were expecting for the United States to operate on a $1.4 trillion deficit this year. That was just a few months ago. But then the tax receipts started to come in, and the Treasury put out a report that showed what their actual deficit was for the first 6 months of 2023, which started in October, right? And that showed that at that point, just a couple of months ago, we were running at a $1.1 trillion deficit for the first 6 months of 2023. So you just do out the math. It's a run rate of $2.2 trillion of deficit, which is way higher than the Congressional Budget Office expected. And at the same time, we're trying to fill up the TGA and have to deal with paying off that old debt. So this is, any way you look at it, it's tightening. And then the last thing that we didn't even talk about was that the Fed is supposed to be selling the bonds that are on their own balance sheet from they're trying to do QT, quantitative tightening, from when they monetize a debt during 2020. They're trying to get this off their books, which is another $90 billion of treasuries every month.
For now, most investors are relieved about the debt ceiling agreement, and they seem to have put the whole issue behind them, at least until we have to do it all again in 2025. With the S&P trading just below its 52-week high, there is almost no warning at all for investors. The coming liquidity crisis will hit hard and fast and break a lot of things in its path. What are your thoughts on James Lavish's discussion with Kitco News? Do you think there's even the tiniest option that the Treasury could refill the TGA and reverse other actions it made between January and May without further burdening the economy? Please drop your replies as well as comments on James Lavish's interview in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.